Think of a financial market that never stops, immune to closing bells and weekend shutdowns. To a new investor, Forex sounds like a cheat code. The pitch lists 5 specific advantages: 24-hour access, unmatched global liquidity, intense volatility, the use of massive leverage, and the ability to profit regardless of price direction. These features suggest a perpetual motion machine, where you can log in at any hour of the day or night and simply print money. This premise hides a mechanical trap that routinely cleans out beginner accounts. Constant access to the market rarely results in constant volatility. Just because the doors are open does not mean the major players are active. Beginners who trade during dead hours often stare at flat-lined screens until they drain their balances through sheer exhaustion and random, low-probability bets. Survival in this market depends on tracking the hidden geography of institutional money rather than simply watching the clock. The Forex timeline rotates through 4 main geographical sessions: London, New York, Sydney, and Tokyo. Regional banks and major investment firms move the highest volumes of capital during the local business hours of these specific hubs. Intense volatility erupts during the specific hours when these time zones overlap, forcing 2 distinct financial centers to process the same volume simultaneously. Macroeconomic crises act as the fuel that ignites this volatility during overlap windows. During the 2010 Greece bailout, localized panic rippled outward, disrupting the standard flow of capital across the Eurozone. This chart shows GDP estimates for Greece following that first bailout. A massive divergence formed between the optimistic 2011 projection in blue and the actual recorded GDP in orange. Shortfalls on this scale destabilize currencies, forcing institutions to rapidly buy and sell positions to protect their assets. The Forex clock functions as a landscape of specific, volatile collision points. These collision points create an essential environmental condition: extreme liquidity. A non-liquid asset, like real estate, may hold high value on paper, but converting that value into cash requires a willing buyer and months of legal contracts. A highly liquid transaction works like a bank check. You hand it over, and it is instantly converted into usable cash. During a major Forex overlap, the density of active participants allows millions of dollars in currency to be bought or sold without delay. Volatility creates the price gaps required for profit, but liquidity provides the mechanism that allows you to extract that cash on demand. Understanding these windows is only half the battle. If a trader's starting capital is too small, even a massive price move produces negligible results. Capitalizing on these windows requires a way to hit harder. Traders use leverage to overcome small account balances. A margin account functions as a mini bank within a trading profile. This account lends the trader exponentially more buying power with a single click, allowing small amounts of capital to control much larger positions. Leverage acts as the power multiplier that makes short, volatile overlap windows lucrative for retail traders. Profitable trading requires looking past the myth of the 24-hour casino. This environment rewards extreme patience, waiting specifically for high liquidity overlap windows to provide a clear, volatile entry point. The ultimate advantage belongs to the trader who uses precision tools to strike exactly when the global financial hubs violently collide.